So having gone through the PowerPoint, looking at the various principles associated with throughput accounting, we're now going to see how to apply these same principles to this question. Now, if you recall, this is your practice question. So I have loaded this up, hoping that you'd have used the time between the last time we met and today, now, to go through the question and try it for yourself. So let me just quickly read through the question. So DSW Limited makes footwear. They have two products, walkers and joggers. Now, they have been designed for different clientele, and that is clearly stated in the first paragraph. But let us go down into the nitty-gritty. The question provides you with the selling price and variable costs, one for raw material and one described as variable production conversion costs. Let me put this in. Now, it goes on to say that apart from these two costs, these two manufacturing costs, there are other costs described as fixed production overheads, and this comes to $1,985,000. Now, the next part of the question talks about the demand, which addresses the maximum amount of product that can be sold by DSW. So when you see that demand for walkers is 80,000 units, it tells you that that is the most that they can sell. And for the joggers, the most that they can sell is $45,000 in a year. So the questions are normally in relation to a year. Now, both types of shoes go through the finishing department, and now we're coming to the issue of the limiting factor. So the finishing department has been identified as the limiting factor, and you're told in the next table how many pairs of shoes are made in 1 hour in this department. So for the walkers, the company can make 5 pairs of walkers using 1 hour of finishing department time, and for the joggers, only 1.5 hours. So it also gives you the restrictions, the maximum amount of resource available for the year, and you're told that the finishing department has a total of 20,000 hours available. So it goes on to talk about just-in-time manufacturing system, where DSW doesn't keep inventory. They don't hold finished goods, and they try to minimize the amount of work in progress, which is basically incompletely manufactured goods. They don't want to keep a lot of work in progress, so they use the word negligible. So what is required of you in this question? First of all, you need to find out, using marginal costing principles, how many walkers and joggers to make, and that is what they mean by the product mix. How many walkers, how many joggers. And what is the objective here? You want to find the quantity of those that will maximize profit. Now, A and B are basically the same question. It's just that A and C, one focuses on marginal costing principles, and the other one focuses on throughput accounting principles. So in our computation, or in our illustrative example today, we will be looking at both those techniques. Now, if you do recall, I did start it off in the lecture, and you were supposed to have finished it up as part of your homework. So let us now go into the calculations. So I'm going to be making reference to the slides that we looked at earlier, which highlighted the different principles. And I'm going to use DSW to illustrate or to bring across the points from each slide. So let us go back to the first slide that is asking what is throughput accounting. So in that slide, it had said that it's a management technique that is used to identify the most profitable product within an environment that is experiencing a limitation of resources. And I've already mentioned that the limited resource in this question is the finishing department, meaning the amount of hours available in the finishing department. So these hours could be in relation to the labor, the people, the skilled labor that is required in making the shoe, or it could be the amount of time the machine is operated for to finish the shoe. The question does not clarify what the process is. It only tells you what is the maximum amount of hours available for the year. Now, again, that slide talked about identifying the most profitable product. Now, because we're only dealing with two products, walkers and joggers, we talk about the more profitable of the two. So what it is suggesting is that we have to choose which one to focus on. But what is the selection criteria? What is going to help us to make that choice? And in the question, they gave us two options: marginal costing techniques and throughput accounting techniques. Now let us go now to the next slide. This next slide tells you that throughput is a calculated figure, and it requires two pieces of data: what the selling price per unit is on each shoe and the direct material cost required for each shoe. So if we look up at the question, the first table, we're told that the selling price for the walkers is $120, whereas the selling price for the joggers is $160. The throughput formula also requires the direct material cost, and again, this is provided by the table: $70 for the walkers and also $70 for the joggers. The slide also indicates that direct labor cost must not be included in the calculation of throughput. Now, this data here does not specifically say that it includes the direct labor, but it is irrelevant because we know what those two pieces of information are, the ones that we need to calculate throughput, and it is the selling price per unit and the material cost per unit. Now, if we were doing marginal costing, we would need another piece of data, but when we reach to that slide in the previous presentation, I will address it. Now, going on to the next slide, it says, how do you go about selecting the most profitable product to manufacture, which is what all of this management technique is all about? And the answer on the slide says it requires the computation of the TPAR, also known as the throughput accounting ratio. So what we're going to be doing somewhere in the calculation, which is part B, is to work out this ratio. Now this ratio, once it is calculated, is presented as a number. And if you look on the slide, you're reminded that when this TPAR is calculated, if the value is less than 1, then that is, if the value for that particular product that the calculation is made for is less than 1, then that product has to be ignored and the focus not placed on it. However, if the TPAR is greater than 1, then we have successfully identified the product that the manufacturer must focus all of his limited resources on as much as is possible. Now, in the TPAR formula, based on the slide, the focus or the calculation centers around 1 hour of limiting factor time. In this example here, for every hour of the finishing department's time. So when we are calculating, we're going to be asking ourselves, first of all, how is the limiting factor expressed? And for us, because the question is not clear, we're not really sure if it is 1 hour of skilled labor or 1 hour of machine time, but it's basically irrelevant. We know that we're focusing on the finishing department, which only has 20,000 hours of available time. Now, I think in class, I wanted to prove, or I think I may have tried to prove, that this 20,000 hours is really not enough to meet the full demand for DSW for these products. What do I mean by that? It means that the walkers, if you were to sell 80,000 of them and 45,000 of them, or put it this way, if you were to make 80,000 of them and 45,000 of them, the time that is required by the finishing department to do that would far exceed 20,000 hours. And if I do recall, I did work that calculation out, and the figure ended up being greater than the 20,000 hours. So what is that telling me? Even though DSW may be able to sell these quantities, they cannot. It's going to be all of walkers and some joggers, or all joggers and some walkers, depending on how these two products draw on or consume the finishing department's hours. So these are the hours of great importance in calculating our TPAR. So the formula for the TPAR based on the slide is the throughput per hour divided by the factory cost per hour. The throughput per hour divided by the factory cost per hour. So it means, therefore, that when we are calculating our numerator or our top figure in the TPAR calculations, we are going to need to subtract these two figures, the selling price and the material cost, as part of the TPAR computation. But because the TPAR also requires a factory cost, this 1.985 million is going to be one of the required data in working out the denominator for the TPAR. And in addition, remember I said on the slide, factory costs include overheads such as electricity, depreciation on machinery, factory rent, as well as direct labor. Now, because we included these two rows of data in our throughput calculation, which is the selling price and the material cost, we subtract the two. This figure cannot be left out. And based on the quantities we had calculated from part A of these, based on the quantities that were required to be made in part A of the calculations, it generated an additional type of cost which had to be included with the 1.985 million to come up with the factory cost. So in essence, the factory cost will be made up of the variable production conversion cost as well as the fixed production overheads. All right? Then when we go to the next slide, that slide lets you know that in this topic, marginal costing as another or an alternative technique is usually introduced as a comparison, which is what we're seeing in part A of the question, where we're to value the profit using marginal costing principles. And if that is required of you, then what you have to calculate is not throughput, but instead you're going to have to calculate contribution margin. And based on the slide, the contribution margin is sales minus variable costs. Sales minus variable cost. So if we go back to the first table, if we're going to compute the contribution margin to answer part A, we're going to have to add the material cost and the variable production cost per unit. So that will be $80 for walkers, $100 for joggers. And that variable cost will then be subtracted from the selling price in order to work out the contribution margin, which is a piece of data in the marginal costing approach. So when we go now into the calculations, which I will do in a few minutes, you will see the distinction, how the figures are applied. Now, how do we now decide which product to focus on, regardless of whether you're using marginal costing principles or throughput accounting principles? We have what is known as a ranking. And in the ranking, what you're trying to do is to find out which product is the most profitable, or in our example here, the more profitable product to focus on. So in coming up with that decision of ranking the product, we have to zoom in on two things: the contribution margin per limiting factor or the throughput per limiting factor or. So we're going to see how we're going to calculate those two figures to assist with the ranking. Now, just a point of reference, in the PowerPoint, the word return is a substitute for throughput. I know sometimes textbooks give you 1,001 ways to describe a particular element in your calculation. So I just wanted to highlight that the word return can be substituted for throughput, and some textbooks call it throughput return. So it all depends on which text you are reading. So ranking the product is a means of identifying your most profitable product to your least profitable product. All right, so having said this, having highlighted the points in relation to the DSW question, we're now going to do the calculations using Microsoft Excel. So here I have on screen, I've split my screen. I have on the right the calculations that I have started for part A. So let's look at part A. Part A says, calculate the optimum product mix that will maximize profit. State the value of the projected profit using contribution margin and in bracket, marginal costing principles. Now, as I mentioned earlier, once you see marginal costing principles, you are going to have to work out contribution margin. So look at what I did here. I took the variable costs, let's go back and look at it. I took the variable cost of $70 and $10 for walkers and came up with a total variable cost of $80. Then I subtracted it from the selling price to arrive at the contribution margin of $40. And I did the same thing for the joggers and ended up with a contribution margin of $60. All right. Now the next thing is that the question asks us to calculate the optimum product mix. Remember I said to you that this column here indicates the maximum that they can sell on each. But because the company cannot meet the full demand based on the limited amount of hours available in the finishing department, we have to find some way of identifying the more profitable product. All right, so now we have the contribution margin per unit. Now what we need to find out now is how, let's answer this question. How much time does 1 unit of each shoe, each pair, use up in the finishing department? That's the question we need to answer. And we're going to use the information from this table to do that. Now, if in 1 hour, so if in 1 hour of the finishing department's time, we can make 5 pairs of shoes, then it means that the time to make 1 will be 1 divided by 5. 1 hour, and in that time you make 5 shoes. Think of it. If you were making 2 shoes, 2 walkers in an hour, you would intuitively know that each shoe should take a half an hour, which would essentially be 1 divided by 2, which is half an hour, 0.5. But because we're making 5 pairs of shoes, we're going to divide the 1 hour by 5. So it is basically saying that each shoe will spend 1 hour in the finishing department for the walkers, that is. Let's look at the joggers. The same calculation, 1 divided by 1.5. And let's change this to 2 decimal places. All right, so we've asked the question, how much time does 1 unit of each pair use up in the finishing department? So this uses up 0.2 hours and the other one 0.67 hours. Let's put this in hours per hour. Oh, my apologies. Okay, so what's the next step? We need to now find out how much contribution margin is earned during this 0.2 hours. So when we divide the contribution margin that we worked out earlier by this factor we just computed, time taken by 1 unit. Let's see what figures we get. And we need to understand what that figure is telling us. So what this information is telling us is that the workers will make $200 of contribution margin for the company if that is what they focus on. But if they make joggers, that same 1 hour of factory time, that same 1 hour of finishing time or finishing department's time will only earn the company $90. $90. And so we talked about a ranking. It would therefore seem that based on the data, that DSW should focus all their resources on making walkers because it generates the most amount of contribution margin in 1 hour. So 1 hour of what? 1 hour of limiting factor time. And can I tell you a secret? If you had taken the $5 and multiplied it by the 40, you'd get the $200 because you know what this table is telling you. This table over here is telling you that in 1 hour of the limiting factor time, you make 5 pairs of walkers. So that means that the contribution margin earned in that 1 hour is 5 times 40, which is 200. And if you do the same for the joggers, 1.5 times 60 is 90. All right. But the fact of the matter is, I just wanted to carry through this approach because the question is not always phrased like this, where you can read off the data and come to this critical row here. All right. All right, continuing. So the product that is next in line in terms of profitability is joggers. All right. So what does this mean? It now means that the 20,000 hours should be applied as much as possible to make all the walkers that they can sell. So we're going to start out this section here now to determine the optimum product mix. That's what we're going to be doing now, to determine the optimum product mix. So the first thing we're going to say is the total hours available in the finishing department. And that came to 20,000 hours. Let me change that up and show the comma. So this is hours. So 20,000 hours are available. 20,000 hours are available. All right. So now we're going to make the maximum amount of walkers because the computation says ranks the walkers as the most profitable. Let me just highlight the ranking for you. And highlight it in red so you'll see. So we're going to make as much walkers as possible. And that came to 80,000 pairs of shoes. So that would be 80,000 multiplied by the 0.2 hours to make one. 0.2. So let's see how many hours that consumes. So we're going to subtract 80,000 times 0.2. So it uses up 16,000 hours out of the 20. Okay, so let us see how many hours remain. Let's quickly do this. All right, so we know it's 4,000 hours left. So these 4,000 hours can now be assigned or allocated to joggers. So we need to now find out how many joggers can that make, bearing in mind that each pair takes 0.67 hours of this finishing department's time. So let's do a rough calculation here. So we have 4,000 hours available, and each pair takes 0.067 hours. So it means then that we can actually make 5,970 shoes or joggers at 0.67 hours. And that should fully consume the amount of finishing time left in the finishing department. Minus 5,970 times 0.67. And that comes to 3,999.9 hours, which is essentially 4,000. So what we're saying here is that we finally arrived at our optimum mix. So let's indicate that. So now our hours are fully consumed based on this optimum mix. So let's state what it is. The optimum mix is equal to 80,000 pairs of walkers and 5,970 pairs of joggers. Now that is a part of question A, because it now wants to find out how much profit. So let us determine the profit from this mix. Okay, let me bold it to show it's a different section. So we're going to pick up the 80,000 pairs of walkers, and we're going to see how much contribution margin it will earn, because it's $40 on each. And why am I using the $40? Profit under marginal costing principles, profit is equal to contribution margin minus fixed cost. In fact, let me put it in the line below to remind you. Profit is equal to contribution margin minus fixed costs. I'm sure some of you remember that. So in what you're trying to do now is to get the total contribution margin for all of those 80,000 shoes. Times 40. And then from the product mix, 5,970 pairs of joggers times 60. Here's the contribution margin up here, times 60. And that will now give us the contribution earned from the sale of these joggers. Oh, I'm trying to put in the multiplication sign. Okay, let's continue. 5970 times 60. All right, so now we have our combined contribution margin, which is the sum of these two. $3.5 million. Then we can now subtract. The fixed cost, and that will give us our profit. If I could spell the word fixed, that would be good. And let's look at it. It's 1,1985123. So therefore, our profit is going to be the contribution margin minus fixed cost. So let me identify this as the total contribution margin based on that optimum product mix. And so our profit is $1,573,200. All right, so that ends our calculation for part A. Let me save this. File save as. Stop. Solution to DSW. Alrighty. Okay, so let us see now. So we've just finished part A. Let's look at what part A says. Calculate the optimum product mix that will maximize profit. And the optimum product mix is 80,000 pair of walkers and 5,970 pairs of joggers. And the other part says, state the value of the projected profit. And this is the projected profit, 1,573,200. Now for part B and part C, we can use both approaches to identify which product is more profitable. But let us focus on part B now. Part B. So I'm going to pause the video to get some data up, and I'll get back to you in a minute. Ooh. Okay, let me pause the video. Okay, so I'm back. So what I have done here is copied our solution from part A and created part B for a question. Now, part B, if we read over here, it says, calculate the throughput accounting ratio for both types of shoes. But notice it also says, assume that the variable overhead cost incurred in A is fixed in the short term. Now, this variable overhead cost will be a combination of the variable production cost for each product multiplied by the optimum mix that we had worked out earlier. So you're going to see how we're going to integrate those figures. And that is what we're being advised by part B. Now in part B, we're going to have to remove this row. Because if you recall, throughput is selling price minus the variable cost. And the only real variable cost as far as throughput is concerned is raw material. So I'm going to change this title to throughput. Okay. Now, the limitation factor still remains the finishing department. And based on part A, it is still going to take 0.2 hours to make one pair of walkers and 0.67 hours to make one pair of joggers. That data has not changed. Now notice that the throughput per hour has also changed. I'm going to change this from contribution margin to throughput because we're dealing with TPAR now. So notice the similarity in the approach. So the throughput based on the time taken is $250 of throughput earned in 1 hour. So let me change this to throughput. So what we have here in this last row is the throughput earned in 1 hour. Now look at this again. This is interesting. The walkers still earns the most throughput. The joggers earn a lower throughput in 1 hour in the finishing department, which is what this row is all about. So what it means, therefore, we're not dealing with the ranking right now. So we're going to take that out. What we want to now calculate is TPAR. Now, by the way, this row is the same as the numerator in the TPAR calculation. So we have the top figure already. So what we now need to work out is the factory cost per hour. Which is the denominator in the TPAR formula. So what is the factory cost per hour? In order to work out the factory cost per hour, we're going to need the following data. It's going to be the total factory costs for the year divided by the total hours of limiting factor available. So we know that the total hours of limiting factor available is the 20,000 hours here. So we have the bottom part for calculating the factory cost per hour. But the top part, the total factory cost for the year, let's change the Y to T, will include two pieces of data. As I've said before, the fixed production overheads, as well as a portion or the variable production conversion cost. So let's get that out of the way. So we're now working out the total factory costs for the year, and it is made up of the fixed production overheads, and that figure came to 1,985,000, and it is also made up of the variable production conversion costs, and we have to find out how much it is for walkers and how much it is from joggers, because we were given the data based on a per unit level. So here's how we're going to work that out. Based on the quantities from part A, that is our instructions, we're going to multiply this by 10, because this is the variable production conversion cost per pair of walker. And then we're going to use the 5,000. Sorry, let me just check by the figure. 5970 times 30. So this will be our variable production cost. Let's quickly calculate that. 80,000 times 10 and 5970 times 30. So when we add all of these up, it will give us our total factory costs for the year. So let's quickly do this. Okay. No, we want the factory cost per hour. So this is the total factory cost for the year, $2,964,100. But we want to work out the factory cost per hour. Per hour of what? Per hour of limiting factor. So what we need to do is to divide this figure that we now have by the 20,000 hours. 20,000 hours. So let's find what the bottom part of our TPAR is. So it's this figure divided by this figure. $148.21 per hour. Now what does this data tell us? This is our factory cost. Per hour, that we're going to put in our TPAR formula. Okay, so now that we have this, we can now work out the TPAR, but can I say that this data applies to both products? Any factory cost per hour that you calculate will apply to all the products in your computation. All right, so let's do our TPAR now. We have everything. We have the throughput earned in an hour. So I'm just going to copy and paste this down here. Oops. Okay, I'll just copy it up here. And do the same. And do the same. Then we're going to take the factory cost per hour. And it's going to be the 148.21. Now I need to explain to you what this means in English. So this 250 tells me that for the walkers, in fact, let me bring down the names. So this is for the walkers. And this is for the joggers. Now what does the 250 tell me? The $250 tells me that in 1 hour in the finishing department, walkers will earn $250 of throughput for DSW. But in that same 1 hour, DSW will incur $148.21 of cost. So it means, therefore, that the walkers are earning more throughput in that timeline of 1 hour than what the factory is incurring as cost. But if you look at the joggers, the situation is reversed. During that 1 hour, when the factory is incurring $148.21 of factory cost, the joggers are only earning $135 for the business as throughput. So what it is telling me is that the walkers are the more profitable option than the joggers. So let me just highlight this. The walkers are the more profitable option than the joggers. And as such, we are going to expect a TPAR which is greater than 1 for the walkers. Let's check it. So it's the throughput earned in 1 hour divided by the factory cost earned in 1 hour. 1.686. Excellent. So now we have a TPAR greater than 1 for the walkers. Let's see what happens for the joggers. Let's copy this over. 0.91. So this 0.91 tells me that joggers is going to lose money for DSW if they focus on that. Okay? Now let's go to question B again. Let's revisit question B. It says calculate the throughput accounting ratio for both types of shoes. And here it is. So it says comment on your answer. And the comment is what I just said. That walkers have a higher TPAR than joggers. But more importantly, it's a TPAR greater than 1. So it means that if the company focuses only on walkers, they will make a profit. However, if they focus on joggers, they will lose money because their TPAR is less than 1. And it makes sense because the revenue that they're earning as throughput is smaller. The revenue that they're earning as throughput in that 1 hour in the finishing department is smaller than the factory costs incurred in that same timeline of 1 hour. Okay? Now for part C, we're going to copy all of A. We're going to copy all of A, every part of A, because it's the same calculation, except that we're going to be using throughput rather than calculating contribution margin. So I'm copying every single thing from our part C. Oops. All right, so all we're going to do here is to take out the variable cost of production to come back to our throughput, which is the same throughput we had earlier, 50 and 90. And we come up with the numerator. Now, because we changed the throughput, we ended up with a throughput earned per hour that is different from the contribution margin earned per hour. Let's change this out. Let's change this out. Now, because the ranking does not change, meaning that based on the throughput earned in an hour, it shows that walkers are more profitable. It means that the computation is not going to change in relation to our answer in part A, because this is still telling us based on the ranking, make walkers. And if you have any resources left, any of the limited resources left, make joggers, which is exactly what we did in part A. So we're still going to end up with an optimum mix, which is what C is saying, calculate the optimum product mix. We're still going to end up with a mix. But the difference now is that we are not going to use the contribution margin. The formula changes. And here's the formula for profit. The formula changes. It is throughput. Minus factory costs. All right. So let us look at the throughput. So it's the same. The optimum mix is the same, but the throughput differs. So 50 and 90. So we're going to change this to 50. I'm going to change this to 90. Oops. And do the same in the data. Likewise down here. So what you're going to get here is not a total contribution margin, but a total throughput. And we're not going to be just subtracting the fixed cost. We're also going to be subtracting the variable production overheads. Let's see if we can pick that up. Here it is. So we're going to borrow this. So we're going to change this to a minus. And change this to a minus. And we're going to end up with our new profit. So here is our new profit. And interestingly, it comes back to the same figure. That looks highly suspicious. Let's just double check it. 80,000. Fixed cost, 80,000 times 10. Okay, well, apparently it comes back to the same figure. All right, so that gives us part C. And then part D is our discussion section. And I'm reminding the class that you must not ignore the discussion section. And so there's a table in the textbook that lays out quite nicely the comparison between marginal costing and throughput. But the main one that you saw being applied in the question was the treatment of the direct labor costs. So, you know, in marginal costing, it forms part of the variable costs. Use variable costs used in determining the contribution margin. But in throughput, it is not used to compute throughput, but it is merged or added to the overheads to arrive at the factory costs. So this is what I'm looking for in part D, where the main difference is how. Well, this is the difference, the treatment of the direct labor cost. So it is, oh, this video is almost an hour, a full hour. All right, so thank you for your time. So I hope this presentation gives you a better grounding on the principle of throughput accounting. Okay, I will see you in class on Tuesday. Have a good day.